Merryn Talks Money listeners, are you a Bloomberg subscriber? If you're not, here's why you should be. You'll get ad-free episodes of this podcast and access to my Merryn Talks Money newsletter, as well as access to John's award-winning newsletter, Money Distilled. And you'll get access to subscriber-only events, such as the one we'll be hosting on March the 17th. See the link in the show notes below to sign up to that. And of course, you will get unlimited access to Bloomberg.com and the Bloomberg app, including exclusive stories and premium market tools. Subscribe now at Bloomberg.com/podcast offer. Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I am Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth. And this week, I am speaking with Edward Chancellor, investment strategist and financial historian. Now, he's the author of The Price of Time, which I'm sure all of you will have read by now. And if you haven't, now is the time to go get it and start reading. He recently collaborated with Jeremy Grantham on the book, The Making of a Perma-Bear, The Perils of Long-Term Investing in a Short-Term World. We interviewed Jeremy a few weeks ago, so do go back and listen to that one as well. And we thought this would be a good moment to have a financial historian on the show, someone to help us point the market moves we've seen in the first quarter of the year into context, both the volatility around AI, but also more recently, obviously, the reaction to the escalating conflict in the Middle East. What does that mean for markets going forward? And more importantly, from Eddie, what does it mean for the price of money? Edward Chancellor, welcome to Merryn Talks Money.
Nice to see you again, Merryn.
Now, we've got quite a lot to talk about, actually. I originally, last week or a couple of weeks ago, when we thought about having you back on, we thought, well, we'll just talk about bubbles, we'll talk about AI, we'll talk about the great rotation in stock markets, etc. But there's quite a lot more to talk about now. But let's start where we originally planned to start, shall we? Let's start with before the new conflict in the Middle East started at the weekend, we were looking at markets and going, look, there is something going on here. We're seeing a shift out of AI adjacent stocks and into something that connects more to real assets. We talked about the shift from YOLO and FOMO to Halo, all these things. Do read columns that John and I have written on those things. So I wonder if I could just ask you to give us your thoughts on that, what you think has been happening in the market over the last few months.
Well, the story about the market's response to AI is, as with every sort of boom or bubble period, there are feedback effects, and one narrative runs for a while, and then another narrative takes over. So I'd say at the beginning of this year, and I wrote a paper with Jeremy Grantham looking at AI from the perspective of previous technology booms, and it looked at the time, you see that Oracle stock had come down sharply. CoreWeave, which is one of these so-called near cloud operators, that stock was off sharply. Then the big hyperscalers, the market was responding negatively to the amount of money they were spending and their collapsing free cash flow. So it looked, you could say quite reasonably at the time that things looked as if AI enthusiasm was waning, but then in the last couple of weeks, we've seen really quite extraordinarily powerful viral AI stories or narratives going around. There was one report or note by someone called Matt Schumer, who's some Californian tech guy, which was story of AI is coming for your job. It was a fairly conventional story, but immediately got 50 million views on day one. But more interesting to my mind was the research that came out, a piece of research that came out by a firm called Citrini Research towards the end of last week, and that was mooting the idea that if AI were ready to realize its potential, there would be a collapse in all white-collar jobs, followed by the mother of all recessions. And that actually is definitely worth reading as a story of what would happen if AI were actually to achieve what the likes of Sam Altman at OpenAI claim that it will achieve. I personally don't think it will get there, and we can discuss that.
Well, why don't we discuss that right away, so we know so we can set this bit up. I mean, the idea being that if AI can really do what its intense believers believe it can, and effectively take over pretty much all white collar jobs, massively improve productivity, then that again gives us a huge level of unemployment and a recession as a result. So the productivity revolution destroys itself.
No, but man, it's further than that. Is that, and this is the point. Goes back to Schumpeter's theory of the business cycle, that a Great Depression is created when a new technology comes along, interrupts established profit lines, and then the debt built upon that profit or cash flow collapses. So, in fact, the Citrini research is really is a sort of Schumpeterian dark picture. And I'm very well expressed. So why do I think humble I, who can't code to save their life, think it's not going? No, okay. So why do I think that it's we're not going to see the Citrini research scenario played out? And I think this goes back. I was thinking it goes back to every bubble. If you think about a bubble, there's always there's a core of truth to every bubble, that something is revolutionary, something's going to change the world, and then there is an element of reality that is being overlooked. So the market, if you will, chases the narrative, and it chases the narrative uncritically, and it doesn't examine the niggling elements of reality. And that is the nature, I'm afraid that is the nature of a bubble. So you call it groupthink, or you can call it sort of people's resistance to dissonant information, cognitive dissonance, call it what you will. So what is the germ, or what's the reality that the AI enthusiasts seem to be overlooking? Well, that's namely that, as far as I can understand, bear in mind, that I'm picking this up at second hand. But if you listen to the AI, certain of the AI specialists, and I'm thinking of Turing Award winners such as Jan LeCun, who left Meta last year, a fellow called Richard Sutton, also another Turing Award winner. And then I listened, and I recommend that your listeners listen to it too, the Faraday lecture given at the Royal Society last week by someone called Michael Wooldridge, who's professor of AI and computing at Oxford. And all of them really say the same thing, that the large language model is not a model that is actually engaged in reasoning. It's not engaged in seeking the truth. It's not engaged in logical processing. It uses, and this is where I get a bit fussy, it uses really a sort of probabilistic framework for guessing, so to speak, what comes next. And it does, an incredible good job a lot of the time. But it also produces these pesky hallucinations. It makes mistakes, and it doesn't correct those mistakes. It can't sort of, so far as I can see, it's not learning from having made a mistake. Now, people like LeCun, Sutton, Wooldridge, they all say that this flaw is inherent to the large language model architecture. So far, the advances with the LLMs have come from using more and more compute, more energy, and scaling everything, and that's led to advances. But there are, to my mind, quite compelling argument that we're reaching the limits of scaling, and that's not me saying it. The person who was saying that towards the end of last year was Ilya Sutskever, who was one of the founders of the LLM model. So think about it this way: if these machines are not really reasoning, are not really intelligent and and whose tendency to create errors or hallucinations are built into the model, how far can you go with that technology?
Okay, so the key point here is that AI is the new wind. Nice to have around the edges, makes a good story, but won't actually change our world.
Well, it's difficult to know where to draw the line. I mean, the other thing I'd say, Merryn, is this, and that I've been doing I'm writing a new chapter for my old book, Devil Take the Hindmost, The History of Speculation. So I'm going over the whole internet bubble of and TMT bubble of the late 1990s. And one thing, what I find interesting there is that, of course, there's a huge amount of hype around the internet from the mid 1990s onwards. And if you look back, actually that hype was justified in the end. If anything, the internet exceeded the expectations of all except the most feverish exponents of the technology, and yet, the Nasdaq was down 80% after 2000 and took 12 years to regain its peak, and even Amazon, the eventual winner of the early dot-coms, dropped 93% before coming back. So the timeline, even when the technology actually delivers, the timeline tends to be wrong. Markets get sort of too feverish about something.
Yeah, but can I just stop there and say to you that one of the things that you and I have talked about before is that you have to have a bubble to build a new infrastructure, right? There isn't any other way to do it. You need overexcitement. You need that fever to actually get the money together to go out and build these very unlikely infrastructures.
I think, as we get into the modern era of technology, like the internet. I mean, think of the internet. These companies laid down hundreds of thousands of miles of fiber optic cable. Now, the businesses that did it, Global Crossing and other companies, they all went bust, and there was massive overcapacity. I don't know, 95% overcapacity. But yes, then you had the infrastructure for for YouTube and video and video conferencing and whatever. You and I like to see things from the point of view of investors rather than society at large. So the my view is if the benefits are delivered for consumers or society at large, there's no need or requirement for any individual investor to provide the capital with the expectation of loss. So that's my, that's my caveat to the, the bubbles being necessary. I don't think there is, let's say, a necessity to partake in them. In fact, actually, I was mentioning earlier to you the Sandy Nairn's book, Engines That Move Markets, which is really a tremendously good book, which I would recommend to anyone who's interested in the inception of how markets respond to new technologies. And it's really quite clear that in the early stages of these new technologies, when there is, so to speak, the bubble enthusiasm, that investors don't make money. There tends to be overinvestment, excessive competition, and then eventually you get a fallout and a shakeout, and then you get dominant companies appearing at that later stage, and those dominant companies often make pretty good investments. You think of AT&T dominating telephone, and we think, obviously more recently of the likes of Facebook and Google, but Google and Facebook were not on offer in the late 1990s. It doesn't pay, frankly, when a new technology comes along, the investor almost invariably in the past would have done better just to stay in bed for 10 years and get out of bed and say, hey, what is this thing? What is this railroad? I'm going to buy some stock. It's just better to hold back. I was thinking that Warren Buffett and Charlie Munger, they used to say about technology that they had a tray saying too difficult. And really, when one looks at the outcome for AI, given these uncertainties that I mentioned earlier about what its capacities might be, and also given the huge amount of investment that a number of extremely well-funded companies are engaged in, and the prospect that the probably quite realistic prospect that that the services they offer won't be particularly differentiated, and therefore will probably earn their marginal cost, which might not even pay back on the capital they've invested. Then why not stay out? Why not go for a halo trade instead?
Is that where we are now, or where we were, let's say, on Friday, on the idea of investing in AI and AI related stocks, or not? Which stage of this bubble cycle are we in?
This is definitely a different bubble or inception of new technology than the ones we've seen in the past, because, as you know, a lot of it is being driven in the private markets. Last week or a couple of weeks ago, OpenAI raised, I put in inverted commas, 110 billion.
Why are we having inverted commas here?
Oh, we're having inverted commas because first of all, there was 50 billion coming from Amazon, of which 35 billion was contingent on OpenAI achieving artificial general intelligence. Well, I've told you there are a lot of people who seem to know quite a lot about AI who say you're not going to get there. Okay, so that's an inverted comma. The other thing is that this is the world's largest vendor financing operation, because Nvidia was putting up, I can't remember how much, 35 billion, whatever, and OpenAI was committing to using Amazon Web Services and buying 3 gigabytes or whatever, or gigawatts of Nvidia compute. Now, if you remember, back in the late 1990s, the likes of Cisco and the other telecoms operators, Nortel, telecoms equipment suppliers, Nortel and Lucent, they were all heavily engaged in vendor financing. Now, the vendor finance, I was reading yesterday, the vendor financing of these companies, which we all thought was an outrage when it was revealed, if you remember.
Yes, we did.
Actually totaled 15 billion. It's small change to compare.
15 billion is small change now.
It is. Well, look, I'm just saying that that OpenAI alone seems to be, in its last funding, roughly 80% of it, roughly 80 odd billion dollars, was a sort of vendor financing operation.
But wouldn't we love to see the valuations of these companies that are still private tested at an IPO?
Okay, that's the other thing, is that I should have said that Amazon, the 35 billion was to OpenAI, was contingent on either achieving AGI or IPO. Wow. Now, these are big companies. I think OpenAI's funding, you see different figures, but I think it's around 730 billion. But some say higher of the valuation. So the question then, what happens when, if and when the likes of Anthropic and OpenAI and SpaceX, if they all come to the market, and throw in a couple of other businesses, and you're getting 3 trillion of new market cap coming to the markets. Whether another scenario, another sort of Citrini type scenario, is you actually have a sell-off as all these companies come and and push into the public market. Yeah, but on the other hand, I was thinking that with the world and particularly the US market, so dominated by passive investment. They say roughly 60% of the US market, stock market, is passive nowadays. Of course, the passive investors, the passive funds, just open up their arms. There's nothing you can't sell them. In some ways, perhaps that some of the thinking is to build up to these huge trillion-dollar valuations and then pass them into the market and get.
Yeah. So once they get to that size, the IPO automatically works.
Yeah, I'm wondering.
Yeah.
I mean, that's something to think about. And the other, again, my view from an individual investor's perspective is that you're already picking up AI exposure. According to JP Morgan last year, roughly 47% of the US market had exposure to AI. It would go up considerably, probably to 55 or 60%, if these AI companies were actually to achieve their IPOs. I think my view is that the individual investor has other things to think about, because there are, as you know, other opportunities in the world, and frankly, the passive blind capital of the index funds will absorb the AI for better or for worse.
Yeah. Okay, let's move on to talking about what's happened over the weekend. And when we've talked about AI in the past, I'm interested that your view of the limiting factor of the future of AI is, in fact, the models themselves that are inherently flawed, so won't do what the biggest optimists think they will do. But the other limiting factor on AI has always been energy use, right? And that's been discussed a lot. And now we're finding that there are massive constraints on energy globally, which I think most people knew before, but those who hadn't recognized before the energy fragility of our world are, of course, learning that now. And you can see that fear reflected in markets. I mean, for example, the fairly massive fall in the Korean market this week is about the fact that it's very heavily dominated by memory chip companies, two big companies, and that the majority of their energy is imported, and that now becomes a major constraining factor on their manufacturing. So we now see this constraint across the board, and that's going to have quite an impact, right? It brings us back to Halo, of course.
On the energy usage of AI, that's a political concern. But before the Iran war broke out, so the U.S. electricity prices have been going up strongly. That's causing political ructions, and there are the question is will the American populace put up with much higher domestic electricity costs to fund the AI rollout, the data centers, and the answer is probably not. And I, last week, President Trump said that the data centers are going to have to start, generating their own electricity, and that should be a good thing, I think, and particularly if it encourages the development of small scale nuclear and other reliable alternative sources of energy. We've heavily underinvested in conventional energy, and, if you will, overinvested in the unreliable alternative energy, and therefore there's a bit of fragility in the system, and when that fragility then gets exposed by a war in the Gulf.
It's interesting. There have been two responses, haven't there, to the war in the Gulf when it comes to energy. One response in the UK is, "Oh my goodness, I wish that we were doing more to exploit our own fossil fuel energy resources." And the other response is, "We'll be needing more wind and solar to deal with this."
Yeah, I got an email from my nephew last night to say that to that effect. We need energy security, and the answer is yes, we do. But the unfortunate fact, and again goes back to the bubble, the important salient facts being missing from the bubble report, is that you're not going to get energy security from from wind and turbines, and we, in fact, Britain, is dependent on importing ever larger amounts of electricity from the continent. Often from gas turbine power stations. I agree with President Trump. I think we need to utilize our own fossil fuel resources if we're going to have energy security, at least given current technology.
Okay, now what does all this mean, do you think, for the interest rate cycle? So before the war in Iran, there was much discussion about easing cycles across the board. We were expecting to see, some people were expecting to see rates come down fairly significantly in the UK. That now seems at risk.
Well, so let's go back to the AI discussion. Citrini research says, that you're going to unleash the mother of all depressions, and that'll be a deflationary depression, and that would be a deflationary depression that was resistant to central bank impetus. So under that scenario, if AI were to realize its promise, then you might say, well, perhaps interest rate, inflation is coming down, deflation will replace it, and interest rates would come down. That's a sort of theoretical position. I think if we have energy and commodity inflation, then you would expect interest rates to rise on the back of in the old days they never referred to inflation as a consumer price. They always referred to it as commodity price inflation. So I think if one is going to get higher energy prices and higher commodity prices, then one would expect the interest rate cycle to pick up. And the only thing I would say there is, thrust of my book, The Price of Time, that I was always saying, no one knows how to predict interest rates. What we do know, the only thing we know is that interest rates run on very long cycles. I'm talking about long-term interest rates, bond yields. And we had a good 40-year downward trend from 1982 to 2022, and we're now in the fourth year of the uptrend. So my view has always been, regardless of what anyone tells you, is we are on the uptrend of interest rates over for decades, and there will be oscillations around it, and those oscillations are inherently unpredictable.
Okay, I'm feeling stagflation and UK public debt crisis.
Yeah, I've been of that view, and incidentally, another, you and I are both sort of gold bugs, correct?
Afraid so.
And
actually, no, I'm not afraid so. I'm thrilled to say I'm a gold bug.
I know,
this is our time, Eddie.
Merryn, I sort of wake up every morning now. I think all these different scenarios of the world. I think actually, yes, gold fits. Take the Citrini model. Everything collapses, and the government finances would collapse at the same time. Then you'd want gold for that. Take the inflation model. Take the inflation and commodity. You'd want the gold for that. Take government debt crisis. You want the gold for that. And so I do think, and I wrote a piece towards the end of last year saying that we are in a new paradigm for gold, and I think that for asset allocation going forward, people have just got to sort of wake up and have gold as the sort of a sizable gold position as the anchor for their portfolio. And when I say sizable, I'm talking sort of somewhere in the range of 10 to 25% of the portfolio. Our friend Russell Napier has 50%, which is fine.
Fine. And does that mean that sovereign bonds no longer have a place in a portfolio?
I think some place, but a much smaller one. I mean, if you think about the 60-40 being 60% equities, 40% bonds being the traditional portfolio, I think you can keep to the 40 non-equities. We go even higher, 50 non-equities, and then whatever isn't your gold position is left over for your sovereign. And then of course you're not obliged to buy sovereign bonds of near bankrupt states like France or Britain. So you can actually buy sovereign bonds elsewhere. You can buy, and then you can also choose to get inflation protected bonds. But I would be, I think the long term, I suppose my long term concern with the bonds is that we are, heading towards a sovereign bond crisis among the advanced economies. And even if you own the inflation protected bonds, there's no guarantee that that when government is slashing pensions and slashing other forms of discretionary expenditure, they don't turn on the rentiers and say you should take a cut too. So I'm very wary, and over the last few years I've been cutting down my inflation protected bond.
Yeah.
Exposure.
And you say we're heading towards debt crisis in various developed economies. Do you feel that getting closer? And we've been discussing this public debt problem for some time now. We both, I think, well, pretty much everyone now sees that countries such as the UK really do have a very severe debt problem, and no ability or apparently no incentive to attempt to cut spending to deal with that sovereign debt problem. So how close is it? And what might make it go away?
Well, I think it would appear much closer in France than Britain, not just because France tax take is much higher than in Britain, and therefore there's less room to raise it. Political paralysis in France would appear stronger, and then you've got the eurozone problem. The fact is, we're now already in a position, and you can see that interest rates in Europe are too high for France and too low for the periphery. So you've got strong house price inflation in Portugal, wherever. Also, we have to see what the outcome of the French elections are. But I think the crisis first comes to France. Yeah.
But let's go back to the equity part of the portfolio. We talked about how much you should have in gold and being slightly wary of the bond element of your portfolio. In fact, while I'm just on that, I wanted to ask you about one of the things that you've talked about when we've been discussing this kind of thing before, is the cracks in the system and how super low interest rates get into all the cracks and you don't see where the problems are until significantly later. I was wondering if you were worried about private credit as the source of one of our future crises.
I'm worried, and everyone else now seems to be worried too. I mean, the private credit story, as far as I see it, is that it was engendered by the ultra low interest rates. We had this period where bank deposits were yielding nothing, and there were these variety of different ways in which you could achieve higher returns, and private credit grew, to fund private equity in large parts, and the private equity, as you know, took over the life insurers in order to have a ready market to buy the private credit issued to fund the LBOs, and so. Yes, I think something like 80% of private credit is what they call sponsor backed or related to private equity, and we know that in the up to the end of the private equity boom, that debt multiples were rising. In short, it wouldn't surprise you to know that I would not be, and have never been, advocating private credit exposure. And with regards to my, to the thesis of price of time, it was always that there would be a crisis eventually coming out from the interest rates, these ultra low interest rates, getting into all the cracks. The only surprise, it's a big surprise to my mind, is that it's taken quite a long time for these cracks to open up. But there we are.
Yeah, everything always takes longer than you think, this kind of thing, doesn't it? Let's go back briefly then, because I've had you far too long and I must let you go, but to the equity part of a portfolio. So, here we are, tricky times. With that 50% of your portfolio that you're holding in equities one way or another, how do you manage that today?
First of all, the other idea of the price of time was, with interest rates very low and a huge amount of, so to speak, financialization, private credit, that one and with money going into these ethereal assets. Can I use inverted commas again? Like,
yes, you can. We can see you. You're on video. You can keep using them.
Into these ethereal, that one wanted investment had to get real. And
Yeah.
so I thought in the 1930s, in 1920s, during the hyperinflation, the Germans talked about die Flucht in die Sackwerten, the flight into things of real value. So I was always in favor of, or I have for a while been in favor of, commodities, traditional energy companies. And in particular, there's another theme to that, which you'll be aware of, the whole sort of capital cycle story of underinvestment. Huge boom in both, in energy investment and mining up to about 2013, 2014, and then this 10, 12-year famine. And so I think, so for me, that has been a core part. It's done a core part of my portfolios for recent years, and it's done slightly too well. It's sort of, I'm now a bit worried about it. And then, like you, I'm a sort of Japan bug. I like the story in Japan, and it took what it took 30 years, for the bubble of the late 1980s to wear off in Japan. And we're now a few years into the recovery of Japanese equities, and the equities not expensive, and they're restructuring, and so I have pretty big holdings in Japan, and I like emerging markets too. I mean, I've been, in the last couple of years, probably most of the new money I've invested largely in emerging. Again, emerging, not attractive 15 years ago, but things change, and I think, again, we're a few years into an emerging, I mean, who knows? I mean, it go up and down, yeah, but a few years into an emerging cycle, and go back to what I was saying earlier about energy, is I don't trust economies that have hugely uncompetitive energy costs. I know that UK equities are cheap, and I know that European equities are cheap, and I'm just, like our friend Andy Lees at Macro Strategy. I think that economy is the transformation of energy, and if you push energy costs out beyond control, it's not the only thing, but if energy costs are too high, you cripple an economy. So I'm just where I actually like to look at a chart and say, who has the lowest energy costs,
and just invest there.
Not just invest there, but think, okay, then which one?
Think through it.
And emerging has, needless to say, very low energy costs.
Yeah, interesting. Well, that slightly brings us full circle, doesn't it?
Good.
Edward, thank you so much. That was really interesting. We loved having you with us today.
Thank you, Merryn.